Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically in the financial system what we had started the discussion over the mutual funds, right? That is the topic we have started for the discussion. Under the mutual fund we having so many headings like this, like the introduction we have, like the basic history we have, growth of mutual fund industries we have, types of mutual funds we have, regulations we have, investor participation we have, and the conclusion we have. All right. Out of these, we have done with the introduction, basic history, growth of mutual funds, and what we were discussing the types of mutual funds, and what topics we are left with. We are left with the regulations, investor participation, and the conclusion. Okay. So basically, in this lecture, what we will do, we will finish this topic. All right. So maybe the pace, you feel a little bit faster, then basically it's for the, you can say, the expiration of this term or to finish this particular series. So please be attentive in the class. So basically closed-ended funds, we had just discussed about the liquidity. The second is the redemption. Investors who wish to exit the fund must sell their shares to other investors on the stock exchange, as the fund itself does not redeem shares. Okay, like we had discussed when we talk about the closed-ended funds. Okay, closed-ended funds, then what we had discussed in it, like the AMC which had issued the closed-ended funds, it's not entitled or not obligated to buy back the funds as it was available in the open-ended funds, right? So that's why if anyone wants to, you can say, step out from the fund, then he or she is required to sell the share to the other investor in the stock exchange, because the AMC which had issued is not going to buy back it. All right. Management. Closed-ended funds may be actively or passively managed depending on the fund's objectives and the investment strategy. Okay. So here two terms we have seen, the actively managed and the passively managed. What is the meaning of it? Basically, if we talk about the actively managed, okay, so the aim of the actively managed fund is to beat the market and gain more and more returns. All right. And if we're talking about the passively managed, okay, so the aim is not to meet the market, but run parallel to it. All right. So basically, whenever we talk about the actively managed, it means that whatsoever the market is going on, the actively managed funds are always try to beat the market. It means, suppose if the market is at plus 120, okay, for example, plus 120 is the score of the market, then the actively managed will try to reach plus 140. Okay, so that they could gain more and more returns. But when it's come to the passively managed, then they are not trying to beat the market, but they are trying to go parallel to it. It means that if the market is at 120, the passively managed will also try to reach the 120. Okay, they won't try to go ahead of it. All right, so this is the only difference between the actively or the passively managed. So closed funds could be actively or passively managed. Thereafter, the interval funds. The interval funds combine features of the open-ended and the closed-ended funds. These funds offer periodic intervals, quarterly, semi-annually, during which they will repurchase a portion of outstanding shares from the investors. Like suppose, if they had launched 100 shares. So they had said that 50 shares they will be redeemed after semi-annually or quarterly. But the rest 50 shares will not be redeemed by them but they will be close-ended. Okay, so that's what we call as a interval funds. All right, which offers a certain portion which could be redeemed and certain portion which could not be redeemed. All right. Thereafter, when we talk about the liquidity part, between these repurchase offers, investors can buy or sell shares on the secondary market if available, or hold on to their shares until the next repurchase offer. So you could say, suppose if the investor has purchased 10 shares, right? So as per the scheme, the 50% of the shares, which means 5 shares will be redeemed, and the next 5 shares will not be redeemed, right? So redeem, not redeem. All right. And suppose the total time period was January to December. Okay. And the deal was at half yearly. It means that after January to July, the AMC or the asset managed company which had issued these 10 shares will be redeemed 5 shares. Okay. If somehow that investor is not, you can say, not happy or not available to resell the shares, okay, at the NAV, net asset value, all right. So after July, the shares will not redeem, all right, because this is the time period. So what will happen, that this person is having the choice whether he could sell the shares to the other investor, okay, or could wait or hold the shares till the next offer, which will be in the month of December. Because after every 6 months, the company, the AMC, you can say, redeems the shares. Okay, so that's the facility provided under the interval liquidity. Okay, investment strategy. Interval funds invest in the variety of securities and are managed according to a specific investment objective or the strategy. All right, like you could say that the portion of shares which could be redeemed or not be redeemed, these are basically, you can say, designed as per the specific investment objective or strategy. Okay, like on which basis, on how many shares they want to redeem, on which basis, and how many shares they do not want to redeem is totally depend upon the objectives and the strategy formulated during the interval funds. Got it? Management. Like open-ended funds, interval funds are actively managed by the professional portfolio managers. Okay, remember, always remember, when we talk about the open-ended funds, okay, so the management is always actively managed. Okay, whenever we talk about the close-ended funds, then the management will maybe actively managed or closely managed. All right. But whenever we talk about this, like open-ended funds, interval funds are actively managed by professional portfolio managers. So you could say, whenever we talk about interval funds, they are always managed actively, right? That's the thing. Always managed actively. It means that the managers of these funds always trying to beat the market or outperform it. Okay, always trying to beat the market or outperform it. All right, while in the passive we had you could say, okay, just correct it. Okay, like closely ended funds may be actively or passively managed, while as we know that in the passively managed, the fund operators not trying to beat or outperform the market, but trying to be or trying to being in the parallel. All right, the fund operators not trying to beat or outperform the market, but trying to being in the parallel. So this is the difference. Okay, so remember the management of the interval funds. Now, after finishing the types of funds, now we have the regulations. Like we know that mutual funds is also the kind of crowdfunding, right? So here we had found a new word which is known as a crowdfunding. Okay, so what is the meaning of crowdfunding? Now I'm asking this question to you, then I will tell you the answer. Do not worry. So for this, you having 20 seconds to think and answer, then I will provide you the answer. Your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13th, 14th, 15th, 16th, 17th, 18th, 19th, 20. The time's up. So basically, if we go by the definition of crowdfunding, okay, so basically the activity in which the certain organization or individual is trying to obtain a money or fund or capital by means of public contribution or public funding. Okay, so crowdfunding is totally the activity in which the certain organization or the individual is trying to obtain a money or fund or capital by means of the public contribution or the public funding. This is known as the crowdfunding. So if we go by the mutual funds, like suppose this is an AMC. Okay, the AMC had launched an offer that we are going to buy the rupees 75 crore security. Okay, so they will ask for the contribution, and suppose there are 5 people. Okay, there are 5 people. One has invested 30, 10, 15. Okay, then you can say 15, and then you can say 5. All right, so just add of them 30, 30, 30, 60, 70, 75. Total price will be 75 crores, right? So basically what they had did, they had launched the requirement, like they need a 75 crores for certain securities or stocks or shares, right? This is the strategy. Got it? And what is this? This is the fulfillment of requirement. Okay. So the AMC is the entity which had launched the requirement, and the contributors are the public which has contributed to it. Okay. So just check out the definition: activity, organization, capital funding. So this is known as the crowdfunding. So the crowdfunding is the, you can say, subjected to regulations by appropriate authorities. Right? Okay. So there are regulations on the mutual fund also. Like first is the AMC. SEBI regulates the functioning of the asset management companies which manage the mutual fund schemes. Okay. AMCs must comply with the SEBI guidelines related to the portfolio management, fund performance, and the reporting. All right. SEBI has set guidelines for the appointment of the key personnel in the AMC, such as the fund managers and compliance officers, to ensure that they have the necessary qualification and the experience. Okay, like asset management companies are the entities which launch the requirements, and the public are the ones who fulfill it. Okay, so basically the first, or you can say the main capturing in this field is on the AMCs. Okay. Like the SEBI issues the guidelines to the AMCs, and the AMCs are become entitled to follow it. Okay. And even they are entitled to follow the guidelines while appointing the key personnel like the fund managers who will manage the funds, and the compliance officers who will ensure the compliance of the rules and regulations, so that the necessary qualification and the experience could be checked out. All right. Scheme categorization and the rationalization. What do you mean by this? SEBI introduced guidelines for the categorization and the rationalization of mutual fund schemes to bring clarity and consistency in the product offerings. Okay. So here we have seen two words: categorization and the rationalization. What do you mean by it? Let's understand. First word what we have seen is the categorization. Okay. It means that grouping funds into categories based on similar characteristics like objectives, strategies, and asset classes. Okay, like you could say, suppose if there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, and 15. Suppose if there are 15, you can say different type of funds. All right. So what will happen? These funds will be classified. Suppose they are classified into three classes: objectives, securities and the assets. So let's suppose 1, 2, 3, 4, 5. These are the part of the objectives. Okay, 11, 12, 13, 14 and 15. They are of the same class of assets. 6, 7, 8, 9, 10. These are the same kind of securities. Okay, so this is called the classification. All right, sorry, categorization. Got it? Thereafter, when we talk about the rationalization, then rationalization means eliminate the duplicacy of same kind of funds to ensure rationality. All right, like if we look at here, how many funds we could see? 15 funds. But when we do the categorization, how many funds we could see? 3 funds. Okay, so this is called the rationalization. First the categorization will happen, then the rationalization will happen. All right, which means that the duplicacy of the funds will be eliminated. SEBI introduced guidelines for the categorization and the rationalization of the mutual fund schemes to bring clarity and consistency in the product offerings. It means that the one who is seeing the schemes will be cleared in his mind that what is going on. Mutual fund schemes are categorized into equity, debt, and the hybrid categories based on their investment objectives, asset allocation, and the risk profile. Okay, like equity funds, debt funds, and the hybrid funds. All right, all of them will be categorized separately. Okay, and the based, or you can say on the based of this categorization, what will happen? The rationalization will begin. All right, thereafter, SEBI's guidelines aim to help investors make informed investment decisions by providing clear and the standardized categories of the mutual fund schemes. Like once the categorization is done, the investor will become aware that from where he has to invest the money, whether he wants to go the equity, debt, or the hybrid model. Okay. Thereafter, the expense ratio regulations. SEBI has prescribed limits on the expense ratio charged by the mutual funds, ensuring cost efficiency for the investors. Okay. The expense ratio represents the annual expenses of mutual fund scheme as a percentage of its average assets net. You can say average assets under management. Okay. So basically you can say, suppose that total expenses divided by average net assets holding by the AMC. So whatsoever will be the answer, that will be the expense ratio. Okay. So basically the SEBI having the guidelines so that the total expenses occur on the funds could be controlled, and that's how the expense ratio which could be controlled, which is charged by the investors. Okay. SEBI regulations help investors compare the cost of different mutual fund schemes and choose schemes that offer value for money. Like suppose you have got 3 schemes: scheme 1, scheme 2, scheme 3, and all of these schemes based on the proper categorization so that you could ensure the rationalization. Okay, so when you examine the schemes, you find that scheme 2 having the value for money, so you could easily go to it. But if this thing is in the chaos, it means that the things will not in the category, the things will not in the rationalization, then what will happen? You will get confused. Okay, so that's how the SEBI facilitates transparency and the disclosure. SEBI mandates mutual funds to provide regular disclosures to the investors regarding the scheme's performance, portfolio holdings, and expenses so that they could make the wise decisions. Mutual funds are required to publish a scheme informed documents and the key information memorandum KIM containing salient information about the schemes for the investors. And the information contains like the amount they are required, the security they are going to invest, the return promise, who will be the fund manager, tenure, redemption. Okay, all of these kind of things are basically mentioned into the SID, Scheme Information Document. Okay, so what is the meaning of KIM? Basically, KIM is okay, let me write down the KIM from the other pen. KIM is precise, or you can say consolidated form of SID. Alright, where SID contains the detailed information, the KIM is the consolidated form, or you can say the precise information. Okay, KIM is issued when the person is become agreed to by the investor. Okay, then the investors protection. SEBI has introduced various measures to protect the interests of the investors in the mutual funds, such as mandatory disclosure of risk factors associated with the scheme and stringent regulations for advertising and marketing of mutual fund schemes. Okay. Also mandated the appointment of the custodian to safeguard the assets of the mutual fund scheme and ensure compliance with the regulations, so that it could be ensured that the professionals are managing the schemes. Here we have the investors' participation. So let's see. First is the systematic investment plans, SIPs. SIPs allow investors to invest small amount regularly in the mutual funds, promoting the disciplined investing and reducing the impact of the market volatility. Okay, so you could say, suppose if you have chosen the SIP of rupees 500 per month through the mutual fund. So what will happen? At a certain date, every month, rupees 500 will be deducted from your account and will be invested somewhere. You are no longer required to do it by yourself. Okay, so that's how the SIP just not only helps to invest the small amounts, but also promote the disciplined investing. Okay, because no longer you are required to make the investment by yourself, the AMC will do it for you. SIP help investors benefit from the power of compounding by investing regularly over the long term, regardless of the market conditions. Okay, tax benefits, yes, like some mutual fund schemes, such as the equity linked savings, offer tax benefits under Section 80C of the income tax. Just note down this one and this one, because this type of questions will be asked for the one shot. So only this thing will be come in your examination. Investment in the ELSS qualify for a deduction of up to rupees 1 lakh from the taxable income. So suppose if 5 lakh is a tax at 10%. So how much you are required to pay? 50,000. But 1.5 will be minus. So it means only 10% will be applicable, and on 3,50,000. It means instead of 50,000, you are required to pay only 35,000 only. So not 3 lakhs, 35,000 only. Okay. So that is the benefit. Okay. Professional fund management. Mutual funds are managed by the professional fund managers who have expertise in the managing investment and analyzing markets. Investors prefer mutual funds for their professional management, helps in optimizing returns, managing risk through diversified portfolios. Okay. Transparency in the disclosure. SEBI's regulations ensure the transparency in the mutual fund operations, including regular disclosure of scheme performance, portfolio holdings, and the expenses. It means that after a certain period of time, the AMCs are required to disclose the scheme performance so far, portfolio holdings, what they have acquired, and what are the expenses they have occurred, so that the expense ratio could be validated. Okay, and the investors could be remain satisfied. Transparent operations give confidence to the investors about integrity of mutual funds investment and help them to make the informed decisions. Diversification. Mutual funds offer diversification by investing in a wide range of securities across different asset classes, sectors, and the geographies. Okay. Helps in spreading risk and reducing the impact of market volatility on overall portfolio. Because if at some place the market is volatile, another place the market is stable. So that you could have a balanced approach from here and there. All right. Convenience and the accessibility. Mutual funds are accessible to the investors through various channels such as online platforms, distributor, and the AMCs. making it more convenient for investors to invest and manage their portfolios. Okay. Low cost. Mutual funds offer a low cost effective way to invest in the diversified portfolios compared to the direct investments, because all the things will be bear by the AMC or the fund managers, not by you. In individual securities, which require higher capital and the expertise. Okay, so after finishing the investors' participation, now we have in the conclusion. Let's see. In conclusion, the mutual fund industry in India has experienced remarkable growth, offering various types of funds to suit different investor preference and the risk appetites. SEBI's regulatory framework ensures investors' protection and promotes transparency in the mutual fund operations. All right. Investors' participation has increased due to ease of investments, tax benefits, and professional fund management offered by the mutual funds, making it an essential investment avenue for individuals and the institutions alike. Okay, so all the things we had already discussed, here we have just concluded them. Okay, so students, basically in this lecture, we had done with the mutual funds. Okay, in the next lecture, we will start with some another topic. Okay, till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.